Welcome back to the Great Retirement Debate. So what's on the agenda for today, Jeff?
Yeah, Ed, good to be back with you. So today we're going to discuss the question, should I give my IRA to charity?
Why would you do that?
Well, that's a good question. That's what we're going to discuss. That's the whole point of today,
You mean
Ed.
you're just going to give your whole retirement account to charity?
Well, I think you bring up a good point, which is if you're not charitably inclined,
Exactly
the
where I was
answer
going.
is always going to be no.
Let me expand on that because people talk about charitable maneuvers, especially with IRAs. No question, I think we both agree, the best asset to give to charity, IRAs. They're loaded with taxes.
If you're going to give to charity, it's a good one to give.
Yeah, but people talk about charity. I would never say give to charity for tax purposes because you have to give the asset away. There's no benefit if you're giving everything away if you didn't really want to give to charity. So what Jeff said, I agree with. This is for those who are charitably inclined. Charitably inclined means you're giving to charity anyway. If you're giving, IRAs are the best assets to give, and we're going to cover two parts: during life through qualified charitable distributions, and to leave to a charity at death, maybe through a charitable remainder trust.
So I think, said differently, you can't end up with more money in your pocket by giving money to charity. Whatever tax break you might be entitled to is not going to account for not going to more than make up for the fact that you've given away money to charity. Now, if you're charitably inclined, you don't care. Now, you certainly want to do so in the most efficient way because it either allows you to give more or to have it cost you less because you're not paying as much in taxes. But there's no way to give to charity $1 to end up with $1.20 in your pocket.
Right. But there are a lot of promoters out there that say you can do all these things and get all these deductions and things like that. So let's go back to the law the way it is now. Most people who do give to charity, and that's the ones we're talking to, get no current tax benefit for their gifts. You get a good benefit because you feel good about giving to charity, but ever since the law changed years ago, there is generally no tax benefit.
And specifically, when you say the law, you're referring to the fact that the standard deduction now is very large.
Right.
So, for instance, a married couple can give roughly, or they need more than like $30,000 worth of itemized deductions to be able to do that, and you only get $10,000 for state and local taxes now.
Right.
So what else? So
and most other miscellaneous itemized deductions are not there. The bottom line, according to IRS, 90% of people take the standard deduction. So there's no longer an itemized deduction available for your gifts to charity, unless you're giving, dramatically large sums.
Yep, exactly. I was going to say, if you're one of those 90%, you take the standard deduction, no income tax benefit for your gift to charity.
So let's talk about, assuming you're charitably inclined, what's the best asset to give? Well, your IRA, as we say. And I think it's one of the best provisions in the tax code, qualified charitable distributions, we call QCDs. The only downside is that it's not available to enough people. It's available only to IRA owners, and believe it or not, IRA beneficiaries who are 70 and a half years old or older, and only available from an IRA. And the way it works, it's a direct transfer from your IRA to a qualifying charity.
Ed, a really important point. I was actually just listening to a webinar recently where it was stated incorrectly. They said, IRA owners or their beneficiaries, if the IRA owner was 70.5.
No.
It's not the IRA owner. It's when the beneficiary gets it. And you said this, but just to reiterate, the beneficiary themselves has to be 70.5 or older in order to be able to make that qualified charitable distribution. And I'm with you in general, Ed. I love QCDs for individuals who are charitably inclined. I don't think there's a better way to give away money. Sometimes I hear people say, well, what about appreciated stock instead? Because they're thinking, well, I kind of get out of the capital gains.
Right.
But to your point earlier, you probably are not getting the benefit because you still have to give away enough to get a itemized deduction. And B, remember, with a appreciated asset, if you hold on to it long enough,
at death, right,
there's a step up in basis. Tax is gone anyway. But with the IRA, there's not ever a point where you get rid of the tax. If you're in the IRA, you're going to owe the tax on it unless it ends up going to a charity via QCD or left to the charity after death. So I think it makes a much better asset.
Oh, I do too. For another reason, though. There's no nice way to say it, but highly appreciated stock is a great benefit if held to death for step up in basis. People who qualify for a QCD
Yeah, you hit the same thing I was going to, yes.
have to be at least 70 and a half. So there's no nice way to say it, but they're closer
They don't
to the
have
promised
50-year
land.
life expectancies. Yeah, yes. Let's just face that. That's not going to be the
So
case.
if you're that close to the, and people live to 100. I'm just saying, the older you are, the more you want to hold on to that till death.
Absolutely. The older you are, the more the QCD makes sense. But even for the typical 70-and-a-half-year-old, you should almost be looking forward to the day when you hit 70-and-a-half so that you can make those QCDs. And one other ancillary note that only will affect folks in that first year. So I don't want to spend too much time on it, but I do see a lot of mistakes. We talk about used to be RMDs used to start at 70-and-a-half.
Oh, right.
And if you turn 70-and-a-half, let's say on December 30th of the year, which, by the way, everyone, is the last day you can turn 70-and-a-half. There's no turning 70-and-a-half on December 31st, no June 31st of the year. So, but let's say you turn 70-and-a-half on December 30th. Well, you only have 2 days in which you can make a QCD. You must actually be that age. So if you turn 70 on June 30th of the year, you turn 70-and-a-half December 30th, you have 2 days in that year you can make the QCD, December 30th and December 31st, and boy, you better hope those are not Saturday and Sunday.
Yeah, right. The way I usually tell people, because they don't, you're right, that's a confusing thing because for other purposes like RMDs, it's just the year you turn 70-and-a-half. So the way I say it to people, if you turn 70-and-a-half, if you turn 70-and-a-half tomorrow, you don't qualify today.
That's exactly right. Now, with the QCD, I think it's a great thing, but I also think that there are potential traps and downsides to the QCD, especially with some of the new changes that were introduced. So as part of Secure Act 2.0 recently, Ed, used to be that the only place a QCD could be made was directly from the IRA to a qualifying charity. But Secure Act 2.0 opens up a 3 new options for folks into split interest entities, which means you get a little bit of a benefit when charity gets the money and charity gets a little bit of benefit. And the 3 are charitable gift annuities, a charitable remainder trust, and a charitable remainder annuity trust. So charitable remainder unit trust, CRUT, charitable remainder annuity trust, CRAT, and a charitable gift annuity. I don't know why anyone in their right mind would make a CRUT or a CRAT.
Right, I agree. Because it has to come from the only funds that can come in there are from the IRA.
That's right.
And you're limited to $50,000, although for this year it went up through inflation, 2024, $53,000. So the best option is the charitable gift annuity, but again, limited to the $53,000, and you get an income back. I just saw an article, and that a couple of months ago, somebody was writing about it, but I went to the comments. I always look at the comments, like especially in the Wall Street Journal, and somebody said, "Oh, it's such a lousy return." That's not what you. They said, "I could do better than that." You get a 5% return because there's an income element back, but that's not why you're doing it. Again, you're doing it because you want to give to charity, but with a charitable gift annuity, you get a little back.
Yeah, and there's the biggest difference between the charitable gift annuity and those other options we talked about, the CRUTs and the CRATs. The same limits of $53,000 apply to that.
Right.
But if you're creating a CRUT or a CRAT, either one of those trust vehicles, the best you could do is have a husband and wife or a married couple who are each putting in $53,000, because the only beneficiaries can be the IRA owner and their spouse. So if you have one trust which gets $106,000, it just doesn't pay to
and
draft
that's a life
the trust.
Yeah.
And every year you're going to have tax returns, and it is not worth it. But the charitable gift annuity is run by the charity. There's no cost of that.
Right. I was just going to say, the 100,000 or now 105,000 of the QCD, that's an annual limit. But the 53 is a lifetime limit.
That's right. So if you have that married couple, you put in 53 each, 106, you're done. There's nothing else you can add. And, run across still people say, well, I have a CRUT already. I'll just put it. No, you won't. Then it's not a QCD. It's only a QCD if the only money that goes into that CRUT or CRAT is the QCD money itself. So I think we agree on this, that should you give your IRA to charity? The answer is, if you're going to give during lifetime and you're 70-and-a-half or older, the answer is probably yes.
Plus, you get the money out. You start bringing your IRA balance down at zero tax cost. Now, it's true, you don't get a charitable deduction because you're using the standard deduction, and you can't double dip. You can't go both ways. But even though you're missing out on, say, an itemized deduction, the QCD is better than a deduction. It's an exclusion from income, which reduces AGI, adjusted gross income. And it can offset, if it's done in the right order, an RMD. Plus, you have this little gap period that Jeff talked about from 70.5 to 73, where you can start lowering your IRA balance before RMDs even begin.
Mm-hmm. Absolutely, yeah. And you hit on the AGI number. Even in the best case scenario, when you get an itemized deduction, it's what they call a below the line deduction. Happens after AGI. But with the QCD, you not only help to keep taxable income low, but also AGI and all the things that are key to that. So, think about everything that's tied to AGI. How much of your Social Security is taxable? Almost every credit that gets phased out as income goes higher is key to AGI. Even how much your Medicare and Part B and Part D premiums will be 2 years in the future is key to AGI. So, all right, we're pretty settled. QCD.
It's a great provision.
Fantastic during lifetime.
It will always save you taxes in pretty much every case.
All right, so what about after death?
All right,
Let's switch to death.
We said IRAs are the best assets to give to charity because they're loaded with taxes. That goes during life, like we just covered, and after death. If you are giving to charity, if that's your plan to leave some money to charity, leave the IRAs. People make this mistake all the time. Sometimes I'll look at their wills or something, and you'll see, I'm giving $10,000 to my alma mater or something like that. I said, why would you do that? If I tell them reverse the bequests. Instead,
and by bequest, of course, you mean what you're giving to someone at death, right?
Right. So instead, give $10,000 of the IRA to the charity. That leaves more money for your beneficiaries that are non-IRA money, less tax for them. And you can do that. You can leave it directly to a charity or a trust, a charitable remainder trust that pays income back to your beneficiary. The only thing I would say about that, if you're going to do that, and again, you're only doing it, I think we said it 10 times, if you're charitably inclined, you get an income interest. The IRA at death goes to the CRT, the charitable remainder trust, pays income to the beneficiary. But what I worry about there, and maybe the family's not worried about it because they want to give to charity, they have plenty of money, but I worry about if that beneficiary dies early, all the funds go to the charity. So I usually advise coupling it with a life insurance policy on that beneficiary. If he dies early, the funds go to the charity, and then at least some of that, or maybe more so, is replaced with life insurance.
That's the option where if you want to kind of help out your beneficiaries, your children, your grandchildren, whoever that may be right now, and then when they die, then the rest would end up with charity, right?
Right,
okay.
Right.
Alternatively, if you're just leaving the money to charity, the best thing probably to do is just to actually name charity on the beneficiary form, right?
Right. But some people want an income interest. That's what you can get with the CRT. The only thing with that is some people are using it when they killed the stretch IRA as a semi-stretch IRA. Simulate a stretch IRA where the beneficiary will get a certain amount each year for the rest of their lives. But you have to know what's right for your family. The beneficiary just can't take an extra lump sum if they need more. They're stuck. But some parents like that to control it.
It's almost like a forced stretch, if you will.
Right.
So a lot of reasons to look at leaving an IRA to charity after death. But there also can be some traps with that, right?
Well, I didn't know if you were going to go there because it's such a mess.
I went there, Ed. I went there.
All right. So now we're going back to Secure, OG, that's what we're calling the original Secure Act. Years ago, before that, in the Mesozoic era, whatever we're calling that, it used to be that after 70 and a half, you could no longer contribute to a tax-deductible IRA. Is that where you were going with this?
Actually, I was going to go with the pecuniary bequest issue after
I
death.
wasn't even going there because,
Well,
you know where I was going with this?
Yes, sure. Going with the idea that if you put to, that is a bigger mess. Yeah, the idea that if you contribute afterwards, you almost have to get rid of your bad, ugly after 70 and a half contributions before making a QCD.
Somehow in the Secure Act, they made a provision that took a great provision. It's a solution, problem looking for, what's that saying? Looking for a solution?
Solution looking for a problem?
Yeah, the other way, whatever it was.
Strike that, reverse it, kind of like Willy Wonka.
What is the right thing?
It's a solution in search of a problem.
Looking for a problem. So you could actually end up with a taxable QCD. So the bottom line is don't take tax-deductible IRA contributions if you're working past 70 and a half and do a QCD. So
but if we're talking about after death, then there may be a trap that some people could fall subject to, right?
Right. It's called a pecuniary bequest or a certain dollar amount bequest. So you have to be careful that the funds go right to the charity. You cannot satisfy, let me put it a simpler way, a pecuniary bequest, like a bequest, a dollar amount bequest, like I talked about before. You have a $10,000, you say in your will, I'm leaving to my alma mater. If you fund that bequest with an IRA, that's a tax trap, because the government treats it, or the tax law treats it, as you cashed out that IRA and gave them the money, and it creates a tax.
You know, a lot of people, though, they don't understand that. They say, but if I gave them it, if my will says give $10,000 to my alma mater, and I took $10,000 out of my IRA and I gave it to my alma mater, won't my estate get a $10,000 tax deduction?
No, it won't, unless you say give $10,000 of my IRA to the charity.
So it has to be, just to be clear, no dollar amount. You don't want to leave a dollar. Better yet, it would be better to just leave a percentage of your IRA.
And name the charity directly. The best thing is, like you said before, if this is what you want to do, name the charity directly on the beneficiary form.
Sure. And if you're worried about, well, I don't want to mix accounts, you can always create a separate IRA.
Right, that's what I tell people.
And put $10,000 in it and name charity the 100% beneficiary of that account, and life is very simple.
Well, the bottom line is, if you're charitably inclined, like a lot of people watching, use your IRA. The only loser is Uncle Sam. Everybody else wins.
Yeah, we call this the great retirement debate, Ed, but I don't think there's too much debate about that.
Not this one.
If 100% pre-tax asset can be given to charity, it's almost always the way to go.
That's right.
All right. Well, what do you think? Do you think it's a good idea to give your IRA to charity during life, after death? What are your thoughts? Let us know. You can reach out to us, Ed at The Slot Report on Twitter, or myself at CPA Planner. Look forward to hearing from you. And Ed, I look forward to our next great retirement debate.
Yep.